Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back, everybody, to the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Back for another podcast, Bills.
Andrew, we are back indeed, mate. And like always, good to be back, right?
Always good to be back, chatting to you.
That front section's never recorded, but I'm sure it sounds identical every single time, right? So, Andrew, lead us in, mate. What are we talking about to our listeners today?
Yeah, today we're talking about something that's currently been happening in the market. And by the time this podcast has been recorded, would have been about a couple of weeks since we've seen a period of some share market decline. Specifically here, where we're talking about really the Australian share market as well as the US market. But just going to talk about what's happening, what's causing it, what do you do, how do you avoid being caught in the crosshairs, but more sort of broadly, what's happening in the market. So a bit of a conversation, bit of a market update, and hopefully some strategies off the back end of it as well.
Yeah, well said, Andrew. There's, I guess it's fair to say there's a lot of stuff happening right across the board. And we'll talk about things like inflation, because that's obviously something that's rearing its ugly head. Both in Australia and overseas, we're talking about or starting to hear about increase in interest rates, supply chain disruptions. Obviously, COVID's still an issue. All of those things are having an impact and playing havoc with investment markets, right?
Yeah. And it's difficult and it's really easy. If you're an investor, if you're looking to get into the market, I think it's really easy for a lot of people to just put their arms up in the air and say, nah, too much going on. And sort of fear starts to paralyze you and you don't move, which, look, I understand it, but I guess a lot of the times if you take the history of the market, that's not the right thing to be doing. And I guess if you're looking at any market in any great amount of detail, that's kind of always the case, isn't it? Like there's always a whole heap going on and always a lot at the same time.
The psychological roller coaster that you go through as an investor, you look at it over the years and stuff, and if you reacted every time that the market did something positively or negatively, you wouldn't get very far because you'd be paralyzed and you'd be constantly changing your strategy and constantly changing your position. And we'll talk a little bit about the psychology and the things that we should be doing at this particular point in time. But I guess a good place to start with all of this is probably inflation. And this hasn't been unexpected.
It's a big word, isn't it?
It's huge. And there's
everywhere these days, or at least in investment circles.
There's a lot to unpack and it's going to affect, and similar to what we're seeing with the pandemic going on, but it's going to impact investors and it's going to touch everybody. Let's be realistic with all of it. So we might even start with a simple explanation as to what inflation is and how it's working its way in, and then what impact it's going to have on investment markets and our, I guess, day-to-day lives as well too.
Yeah, look, sort of as sort of touched on, Bills, I guess a good starting point is what is inflation? And inflation is really the price of consumer goods and services. So how much you pay for goods and services is ultimately a determining factor on what inflation is.
Just before you go on, Andrew, I might just unpack that just a little bit, because when a government measures inflation, they do it on a specific, what we call a basket of goods. And what we mean by that, and in this instance, it's the government, but it's not a basket of goods like you go to the supermarket and buy your groceries and say, okay, today a loaf of bread is $1. Next week it's $1.05. So inflation's gone up by 5%. It's a weighted basket of things that people would consume in their ordinary course of life. So it takes into consideration cost of food, cost of transport, housing costs, education, and so on and so forth. So when we refer to it as a basket of goods, we're actually talking about all of those things right across the board. Because I think, at least back in the early days of my investing journey and my education with financial planning, when somebody would say that, I actually thought it was the supermarket. I probably shouldn't admit that. We might get the editors to rub that out. But yeah, essentially that's...
I'm so glad that you admitted that. I'm loving the fact that I'm going to be able to hold that over you.
So, hey, a little bit of honesty never went too astray. But yeah, essentially that's how inflation is being measured. So it's not in a basket of goods that you go to the supermarket and buy. It's across the economic environment of stuff that we would consume as households. It's a combination
of everything that you're spending money on.
So sorry to cut you off. I just thought that that'd be relevant.
And so what really we've been seeing has been a really or an unexpectedly high number or high level of inflation in terms of the numbers that have been coming out and the numbers that have been reporting. Now, unfortunately, what that also means for share markets is a negative in terms of the expected growth from companies that people are being invested in. And there's a variety of reasons. And obviously, we try to sort of nail things down to one factor, but it's obviously multivariate. But one of the largest impacts to share market is a positive inflation number or a higher than expected inflation number. And the reason for that is when you're considering a company, when you're considering the goods and materials that they're using to produce a good that they're selling, it's obviously squeezing their margins. So when you're paying more for an item, you're having less money in terms of profitability unless you can increase your price from a sales perspective. And so that's having a negative impact on the share market at the moment. And those inflationary numbers that have been released are having some concern around investors. And that's why what we're experiencing over the last couple of weeks is a negative rate of return with a lot of companies.
I might just try and add a little bit more meat on the bone there, Andrew, because it is difficult to get your head around sometimes. But essentially, inflation in a real simplistic term is stuff gets more expensive. So from a household consumption perspective, if stuff gets more expensive and you need to spend that money, so think about household consumption, you have less money left over or less surplus left over at the end of that cycle, whether it's your pay cycle or what have you, but you've got less money to spend. So what households tend to do when inflation increases or when things get more expensive is they look at their spending and they tighten up their spending. So from a household consumption perspective, we're seeing a contraction. And then what you were referring to before with a business, stuff gets more expensive to produce because your input costs are more expensive, your materials more expensive, your cost of labor might go up, your cost of transport might go up. They try and pass as much of the cost as they possibly can onto a consumer who, in this perfect storm, is actually tightening up their household budget. So they're very, very sensitive to where they're spending money. So you've got this perfect storm where costs are getting more expensive for businesses to produce goods and services, and then households are needing to spend more money to purchase the same amount of goods. So as it turns out, households contract and don't spend as much. And it's kind of this self-fulfilling prophecy that as people and households start to consume less, that actually gets worse and worse and worse for the economy, which poses an interesting question for the government on how they stimulate the economy. So I thought I'd add a little bit more onto the bone for that one, Andrew, and hopefully that came across.
Which is kind of the perfect segue as well, because what we're also seeing is a talk of interest rates increasing in order to combat inflation. And that's obviously having another impact in terms of household consumption, because as interest rates increase, the cost of borrowing increases. And as a result, not only are people feeling the pinch in terms of inflation numbers increasing and the cost of goods, you're also feeling the pinch from, and not that that has already occurred, because really interest rates, or the RBA at least, hasn't increased rates yet, but the expectation is that they will. So not only are we seeing a squeeze in terms of household budgets from inflation, but also from a cost of borrowing and a cost of paying a mortgage as well.
Yeah, and that one's such a big one as well too, when you consider that a large portion, and we're talking about mortgage holders in particular, we're talking about a large portion of the household budget, somewhere between the vicinity of 20 and 25 or 30% goes towards repayment of a mortgage. If that becomes more expensive because interest rates have gone up, then that just exacerbates what we were talking about before, where families and households have less money to spend on everything else. So we're entering into a really interesting time here with inflation increasing. Interest rates obviously need to go up to combat inflation. It's going to be interesting to see how this plays out. And I guess from our perspective, even though we haven't seen interest rates increase that much as yet, we've seen the banks obviously move a little bit independently of the Reserve Bank, and they have been doing that for quite some time because their borrowing costs have gone up. The Reserve Bank, as early as the other day, have kept interest rates on hold. So they haven't made a decision to do anything yet, but there's a lot of commentary in the media around when that's going to happen. And I imagine the Reserve Bank is probably going to hold off as long as they possibly can with this, because they do recognise that, especially in an environment where we've been fortunate enough to have cheap money for our mortgages for a long period of time, any increase that we're going to have is going to come out of left field because we haven't experienced that in such a long time. So the government are very, very in tune with what this is going to look like for households. And I'm sure that they're looking at data on a frequent basis just to make sure that they get the balance right between keeping things in check with inflation and not hurting households too much. Because if you dial that up too quickly, then it's going to cause, assuming that a lot of people are carrying a lot of debt, which I'm sure that's the case, but it's going to cause some pain for households, no doubt about it.
Yeah, absolutely. Absolutely. And I think it's also a good sort of analysis and reflection piece around markets are preemptive. So just because the interest rate hasn't increased from an RBA perspective yet, the way that an investment market will work and the way that sort of an investment market will operate is not waiting for that event to actually happen, but rather preempting the fact that that event is going to happen. And so the market is taking a cautious approach around valuations because it's preempting that something is about to happen.
So with those businesses, you're saying that the market is anticipating that it's going to be harder for businesses to make the same level of profit because inflation's increasing.
Right. Exactly right. Look, you also look at the other side of the equation as well. When you're talking about an increased interest rate and when you're increased borrowing costs, that's also impacting business too. So a lot of businesses carry debt. A lot of businesses purchase their materials and raw materials on debt. And so not only is inflation going to have an impact on the profitability of those businesses, but also rising costs in terms of borrowing as well.
Yeah. You can kind of see when you talk through this how all of these things start to have an impact, and then obviously the economy can slow down and things like that. I mean, look, to try and put some sort of positive spin on all of this as well too, because, we don't want to be doom and gloom with all of this, but at least in Melbourne where we're located, we're starting to see, I guess, whether this is the opinion shared by a lot of people, but it's my own personal thoughts around this. But in terms of COVID, I feel like we're starting to learn how to live with it. And if we get, I guess, better at learning how to live with it, that should help people return back to normality. People getting back into going to work at their physical location, even if it is 3 days a week or whatever it may end up being. But then you've got all of the added effects with the economic stimulus that happens with that. You drive to work, you park your car, you're spending money doing all of those things. You go out with your workmates and get a coffee in the morning. You go grab your lunch at lunchtime. That should help as we start to get more and more used to this. Hopefully we're starting to see some positives in the economy in terms of our behavior, and that consumerism starts to kick in as well too. Hopefully that seems to offset some of this stuff that we're talking about.
Yeah. And ultimately that really showcases that in an economy and in a functioning economy, the biggest thing that's going to impact the market and the biggest thing that's going to impact investment growth is expenditure. If households aren't spending, or if they have a contraction in spending because of things like inflation, because of things like interest rates increasing, you really need households to spend in order to get an economy ticking along. And so exactly right in terms of what you're saying, as hopefully things start to open up a little bit more, as people start to consume more, then you expect to see the market to start to stabilize and potentially in some instances recover as well.
Yeah. Yep. No, absolutely. One of the things I reckon we need to call out, Andrew, is probably what we've been seeing more so overseas than in Australia, because that seems to be the market for it. But we've seen, I guess with COVID and what we've gone through, this massive rally with technology stocks.
Yeah, kind of reminiscent of the .com boom, isn't it?
It is. And we saw, I guess, a lot of technology businesses, and primarily most of them are located, that we know anyway, that people sort of think about when you think about these types of companies, are located in sort of North America. But what we're seeing now is, I guess, hype and future prospects and cheap money will only drive a share price to a certain level. And then people realize that, hey, maybe it's not all it's cracked up to be. Maybe the earnings are going to take longer to get to where we had expected it to. And all of a sudden, people start selling out. That enthusiasm wanes for a share price. And all of a sudden, what we're seeing is businesses that weren't necessarily making either profit in some instances, because a lot of the tech companies haven't been turning a profit, or they haven't been making as much profit, or the profit growth isn't as strong as what they had, I guess, projected or anticipated. We've seen a lot of technology stocks come off the boil of late. And that's really been leading the drive, I guess, with the American stock market, leading that down. And we're seeing some well-known businesses, and maybe not your top tier, your Alphabets of the world, your Microsofts, your Apples, Facebook's an interesting one. We'll talk about that in a sec, because as at last night, they came off the boil a fair bit, because they missed their earnings guidance. But we're seeing a lot of the second tier technology stocks come off the boil with that. And that's been having a pretty big run, or causing a bit of a run on the stock markets as well too, where it was just previously work from home. These technology companies are the next big thing. Everybody's going to use their services in perpetuity. They're going to keep breaking earnings records month in, month out. All of a sudden that's changing. And we're seeing with big companies, the numbers that the share price has gone down is quite dramatic.
Yeah, it's a symptom of a problem that we experienced in the past. And it's a symptom of what was happening previously, which you've touched on and alluded to, is there's been so much hype and there's been so much demand for technology-driven companies that investors just started flooding the market. As I sort of touched on earlier, it's reminiscent of the dot-com boom, where it didn't matter whether those companies were turning a profit. It didn't matter whether those companies were good companies, whether people should be investing in them. It's just a technology company, so it must be good. And
it's a good story.
Flooding.
Yeah.
And so what we're starting to see now is those valuations and those companies starting to revert back to their intrinsic value. Investors are starting to realize that, hey, I can't just invest in anything just because it's got technology in its name and just because they utilize technology. I need to actually look at, are they turning a profit? Is it viable that if they're not, that they will be in the near future? And what's the future earnings capacity of that business? So we're starting to see valuations revert to normality, which really, for us, it really highlights the importance of making sure that when you're investing in something, you're not investing in that company or in that asset just because there's a hype around it and just because people are talking about it and because it's in a certain industry, but because that specific business or that specific investment has viability for the future.
Yeah. And I guess that comes back to basic investment principles, that you're making sure that you're investing in quality companies. And in these instances, I mean, the story with all of them sound great. All the glossy brochures always sound fantastic, but it's popping up the hood, having a look underneath, having a look at what the business model looks like, and actually digging a lot deeper to then realize, hey, is this a good quality company? Does it have good future prospects? Or is it a blip in time that, yes, it fits the circumstance that we're in because we're all stuck at home, but then when we get used to living with this or we improve out of the back of the pandemic, things are going to change and go backwards. It's quite an interesting phenomenon. But yeah, back to basic investment principles, that you need to invest in good quality companies all of the time and not just jumping on the next brightest great idea. And we've seen it before. You spoke about the dot-com bubble before, around people getting caught up in the idea of a business and what it's capable of achieving and what it wants to do, and setting a mission that sounds attractive is completely different than actually executing on it and building a business that's got recurring earnings and so on and so forth. I always find that that's quite interesting.
Yeah. And sort of, I guess, while we're on the topic, what happened with Facebook, Bills? What's going on there?
Look, pretty simple. And I'd say Facebook's always an interesting one because they are a huge business and, you know, they've managed to monetize their platform, and Mark Zuckerberg's pivoting the company into a interesting direction with the metaverse and changing the name of the business and doing all of that. But they had their earnings call last night and they missed their earnings target. So essentially what that means is that they tell the market through the analysts that they communicate with that, hey, this is what we expect our earnings to be for this period. At the end of that period, they'll report them, issue them to the market. And if they've missed that earnings guidance, the market will punish them. And essentially what we saw last night is that exact thing happened. They missed their earnings target and they got punished quite severely by the market. And it's that simple. And if you think about it from an investor's perspective, if you're an investor who is invested in Facebook and you're expecting X and you got Y, and you can't see my hands here, but you can imagine that X is up here and Y is down here, you'd be disappointed that they didn't deliver on the projections that they had told everyone that they would. Their stock becomes less valuable because they haven't performed the way that they had told the market that they would. So in that instance, we saw, I think it was a 23% decline overnight with Facebook, or Meta stock as they're called now. So the market absolutely tore them to shreds. And I think it's a combination of a couple of things. I think it's a combination of not only did they miss their earnings call, but there's some of the hype and the realization, and especially around a lot of retail investors have gotten into the market as well too. I think it's a lot of that shine starting to come off a little bit as well, knowing that, hey, just because I'm invested in a technology company, it doesn't mean that it's going to grow at 100% a year or 50% a year or even 25% a year. That's phenomenal. So I think it's a lot of that. But yeah, Facebook, which is an example that most people would know, is a really good example of some of the stuff that we're talking about.
Yeah, absolutely. Absolutely. Which, I mean, I guess is on one hand, if you're invested in Facebook, it's obviously to your detriment. On the other hand, and look, I don't have the answer to this, so in no way am I sort of trying to encourage this in any way, but it could be a potential buying opportunity as well. So sometimes the market overreacts and sometimes the market can really tear a company to shreds when they have bad news. And what that can present itself is an opportunity to purchase into that asset. It's all about determining, okay, what's the viability of that investment and what's the viability about future prices and future earning capacity to be able to look at, all right, is it a buying opportunity or is it just leave it where it is and don't look at it?
Really good segue into what we were alluding to before about, I guess, two things. One, the psychology of the investing journey. And the second thing is, what should we be doing in this instance? So using the Facebook example, yeah, freak out. Okay, great. You lost 23% of your value. Do you still see it as a long-term prospect? If they execute on the meta, they're going to be the biggest, most valuable company in the world. On the metaverse, I should say, they're going to be the biggest and most valuable company in the world. If that's your thought and they're going to be able to monetize it and that's that, then yeah, maybe you turn around and say it's a very worthwhile company. I'm going to hold it for a long period of time. So this is only a blip in time. You could turn around and say, actually, I own Meta or Facebook shares and I'm going to buy more to try and take advantage of the fact that the price is down. Or you're going to freak out and potentially sell it. Or freak out, whinge about it and potentially not do anything and just freeze. All part of the investing cycle and the psychology,
all part of the market psychology.
All of the stuff that we should go through. So I guess it's really, there's no one size fits all with this, but it's different depending on what circumstance you're in. And I guess a lot of the people that we talk to in terms of their investing journey, you need to continue to stay invested because you've got such a long time frame in terms of investing. So a lot of the stuff that we come to clients and talk to them about, especially during this time, is these types of market cycles going up and going down. This is all part of investing. And that's just how it has been and how it will be. Andrew, what do we tell them? What do we do?
As you said, you got to look at your personal situation first and foremost. Before you even consider the investments, before you even consider anything, you have to look at your situation. Now, there are some clients that are in retirement phase and are drawing down on their investments. Now is a good point in time to relook at that. So what's your personal circumstance outside of your investments? Do you need to draw down on your investments? Because if you don't, then one strategy may be hold on, don't draw down on your investments, don't capitalize your losses if you expect things to recover and normalize into the future. So have a look at if you are in that drawdown phase, if you are in that phase where you're drawing an income from your assets, can you put a pause on that for a period of time in order to not liquidate your losses? The other thing is, do you have surplus money aside that you want to take advantage of the low asset prices? Are there companies that are good quality companies that, as you said, you can hold over the long term and you've got an opportunity now to buy them at a discounted value with the expectation that that will recover in the future and that you're obviously going to monetize your profits in the future. So really taking a look at your own personal circumstances, what you can do with the money that's coming in and out of your own personal bank account before you start to actually examine the investments is usually the first sort of starting point. On from there, then you start evaluating, okay, where is my portfolio currently positioned? Did I have a really heavy weighting towards this tech sector because I got caught up in a hype and I got caught up in the bubble? I see it time and time again where people become emotional about their investments. I've entered into a position, I need to stick to it and I need to ride it out.
It's got to be right.
Yeah.
Everyone wants to be right.
Exactly right. And it's one of those things that you really need to look at it unbiased. You need to look at it without any emotion and say, okay, I got caught up in a hype and I've lost an amount of money. Cut your losses. Move on to something else. Move on to something that's going to deliver you a profit and something that's going to help expand and grow your wealth, don't stick to a position or stay the course with something that you unfortunately made an incorrect decision with. So I don't know whether this gives you any clarity or makes things more difficult, but I think that the most important thing is determine your personal financial situation and what you can do in terms of adding or stopping withdrawals in periods of market declines. And onwards from there, look at your portfolio, look at your holdings, look at everything honestly without your own preconceived ideas and without trying to have your own confirmation bias around the decisions that you've made in the past.
Yeah. No, really well said. The thing that jumps out at me is needing to have an investment strategy, sticking to it, turning down the noise, because you can get caught up in this. And if you listen to all of the media hype, you'll freak out and you'll make a wrong decision. But ultimately, I think it comes down to having the discipline of sticking to your guns. So from our perspective, when we're talking to people, I guess the only certainty that we can really tell people when it comes to investment markets, because you don't know what's going to happen, is when good quality companies do come off the boil that have good long-term prospects, there's a buying opportunity. So if you're in a position to buy, it's always a good opportunity to try and do that. Once again, like what you were saying, Andrew, it really depends on your circumstances. And I guess that then ties into sort of some of the stuff that we've been talking about in previous podcasts, is making sure that you've got a robust and a sound financial strategy. Because if you've got your cash reserves, if you've got your budget set up, if you've got your insurances in place, it's one less thing that you have to worry about that the markets are starting to tank and you've lost 5% of your holdings, because you've got a strategy in place and you've already thought about these things and ticked off those other things and got them organized. And that seems to, I guess, make that process and that decision a little bit easier with less emotional baggage attached to it. And you're right, absolutely less biasness in there as well too.
Yeah. And expect it. I mean, that's the only thing that comforting was, that if you're starting your investment journey, you got to expect that these things are going to happen. There's going to be periods of time where markets are going to be going down. People are going to be fearful. People are going to be telling you to sell out. You have to expect that there's going to be market declines. There's never any scenario where someone is making money hand over fist, and
it continues
forever in perpetuity. It never happens. So you have to expect that there are going to be declines. You have to expect that that's going to happen, and that's all part of investing, and that's all part of the journey that you take yourself on.
Yeah. And as much as we tell ourselves that, I mean, it does take a lot to stay invested during this time. And I've heard it with maybe clients that haven't had as much investing experience and things like that. But, you know, you buy in and you sell out at the right times. Now, the truth is that sounds like a great strategy if you knew when that was. But the truth is nobody does. So
maybe,
and then
Warren Buffett, but
well, not even him, you know, based on sort of the investments that he's made. I mean, he's made really good long-term investments and just held them, but you can't pick it. You can't pick it. And then you go and add transactional costs and tax considerations when you are exiting positions and things like that. It's impossible to do. You know, you may catch it. Let's use a recent example when the markets had a downturn when COVID first became a reality. So March 2020. Markets came off the boil quite aggressively. So in the month of March and into April as well, we saw a huge decline. There were a couple of people that we knew, clients of ours, that sold out, and they sold out at exactly the worst time. You have a look what happened. Markets have gone back up. There was no way known that we could have picked that as investors, as financial planners, as stock market analysts. Nobody would have picked it.
No. And look, I think it's also important to consider the context as well. A lot of the times, it's really easy to say that, hey, the stock market's off 7% from its peak, but it also did in the 12 months prior to that, a 17% rate of return. It's like, well, you're still 10% up. Like, you can't just look at the bad and exclude all of the good stuff that happened beforehand. You really need to average it out. And likewise on the upside, you can't make 17%, think you're a genius and decide to pour everything into it, because you also need to look at, it's going to average out and it's going to smooth out over time. And provided that you're in there for the long term, provided that you're making the right investment decisions around good quality assets, provided that you've got the right strategy in place, and provided that you're constantly reviewing it, you know that you're giving yourself every opportunity to make as much as you possibly can by taking on as little risk as you possibly can.
Well said, well summarized. I don't think there's much more than you can do as an investor than what you've just described. That's probably a good area for us to leave our listeners. Hopefully we've given them a whole heap of value and some ideas around what the market's doing, what we're seeing at the moment, and some of the things that you should consider to try and protect your position. And not only just protect your position, but give yourself a little bit of comfort knowing that this is part of market cycles and it does happen. So Andrew, as always, thank you. Appreciate your time.
Thanks, Billy. Always a pleasure to get in here and record another podcast. And thank you to everyone for listening as well.
Catch you on the next one.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.